So for this session, we are joined by another Brains Trust. So we have Stephanie Biggs, partner at Simpson, Thatcher and Bartlett, Ed Hammond from Collar Capital, Jerry Paul from Queen's Park Equity, and Aranpreet Randhawa, partner at Fried Frank. Lucky you told me how to pronounce that, not phonetically. Now, I will issue my very stern warning. I'm in charge here of the timing, so if you could keep your answers to 3 minutes, that would be great. But I mean, you know, do feel free, if you want to speak more to begin with, we can always tighten it towards the end. So let's kick off this session with a question to you, Aranpreet, which is your focus is on structuring for European and international investors. What are the key structuring considerations for investors based beyond the UK? And when determining where to domicile a fund, what is the biggest factor? Speed to market access for fundraising, that sort of thing?
So I think when thinking about where you're going to domicile your fund, you have to be slightly cognizant of where the market is at the moment, and where we're sort of out of the frothy years 2 or 3 years ago where GPs were able to raise capital very, very quickly. Investors had lots of capital to deploy. I think we're in a slightly different environment now. So I think when we're looking at where to structure funds and having these discussions with our clients, it's a case of balancing, you know, what's going to cause the least amount of friction with your investors, whilst also making sure that from an operational perspective, you can do everything you need to do with the regulator, get your fund set up, and still operate it over the next kind of 10 years without too much headache. So I think first and foremost, kind of making sure that your investors are able to easily check the box and say, yes, this is a jurisdiction that we've invested in a number of times before. We're familiar with it. We're comfortable with the regulatory and tax overlay, I think is a big requirement. And certainly with Guernsey, given that there have been kind of predominantly PE funds, but now across asset classes, funds based in Guernsey for many decades, I think it's certainly a jurisdiction that not only European investors, but global investors are very familiar with. I think that the kind of secondary issue or factor at play is the kind of the ecosystem that the fund industry can provide there, and Mark alluded to it on the previous panel, but you know, a strong reason for a lot of our clients wanting to choose Guernsey is that there's a very well-developed asset management industry that supports the funds that they are raising, and the ecosystem is there, and that means that, you know, your interactions with the regulator are much easier. There is much more dialogue and back and forth when there are questions. There are reasonable AML requirements, which your investors are going to be very acutely aware of. And all of this, I think, feeds into kind of speed of setup. And again, getting to that point about there being a frictionless process when you are not only onboarding your investors, but also engaging with them throughout the fund life. And I think with all of this, it's probably worth bearing in mind that a lot of our clients kind of fall on kind of different sides depending on kind of where they're coming from and what investors they're targeting. So I think what you also have to think about is, look, where is your capital coming from? If it's predominantly US investors, then having an onshore vehicle on continental Europe, you know, may not be justifiable given the additional cost and expense of doing that. But if you're, you know, if the weight of capital is coming from Europe, you have to query whether, you know, you could benefit from marketing passports, or are you able to set up in a jurisdiction like Guernsey, which a lot of our clients find and rely on things like national private placement regimes to make sure that you are still able to access the capital that you want to access in continental Europe. So I think the kind of upshot of all of this is there's a lot of good things about Guernsey, both in terms of the decades of experience that are there, the trusted advisor network, both on the kind of legal side and administrator side. But for each of our clients, it's a very individual decision on exactly what they're looking for as well, which is also something to bear in mind when having those discussions.
Thanks, Aranpreet. So, Jerry, there's naturally a lot of focus on regulation, but what about the culture and nature of the regulator itself? How does Guernsey's regulator compare with other jurisdictions?
So I think Guernsey's in a very privileged and enviable position in some respects, in that it's halfway between Europe and the UK. And to be able to take advantage of that situation, you do need a regulator that is sympathetic to that and also understands how to operate within that environment. I mean, taking regulation as a whole, you kind of have the rules-based regulators like the SEC, and to a large extent as well, those driven by the European directives in Luxembourg and Ireland. Whereas UK, FCA, and also the GFSC, much more principle-driven. So that allows them to be a lot more flexible about how they apply certain regulations to certain situations. I think if I was to sort of characterize the GFSC, I would say nimble and collaborative, I think would be the two words I'd use. In terms of the nimbleness, that drives product innovation. We heard earlier from one of the previous panelists around the Green Fund. You know, that's an example of a new structure being regulated effectively and efficiently. Blockchain, ESG are other examples. I think the best example is probably the private funds regime. Came in 10 years ago or so, and it's now been announced today that it's been upgraded. And I think that upgrade is as a result of industry collaboration within the island. I mean, the island is small, 65,000 people. Why not take advantage of the fact that the regulator, the lawyers, the accountants, the administrators can all talk to each other very easily and actually provide something that the market actually wants. So the changes to the private funds regime, I think, are welcome. Certainly from my perspective, it helps us immensely by allowing us to upgrade the number of investors in our funds without having to change the regime. I think the other point as well is that collaboration also generates speed. Trying to get something done either in the UK, even with a principles-based regime, takes time. Trying to do the same in Luxembourg is pretty much impossible. Guernsey, you can measure things in days. Other jurisdictions, weeks and months. And I think the point about that is that there is a genuine collaboration between the GFSC and the professional practitioners on the island that allow registrations to happen extremely quickly. That's all well and good, but you've also got to have a reputational quality that is global, and Guernsey does possess that. So it is recognised by OFAC, FATCA, there are no grey list issues, there's no blacklist issues. It's actually even got third country AFMD status within the EU, which points to the quality that the world holds, you know, Guernsey as being able to achieve and deliver. So I think in that sense, you've got a regulator that is playing its part to the full in developing the financial community.
Thank you. Stephanie, this is very much your area of expertise. So can you set the scene for us on what we're seeing from a regulatory perspective? What changes have you been keeping an eye on in the UK, but also globally?
Indeed. So I think there's a little bit of a tug of war in the regulatory space at the minute. We had a little bit of a lull, and now I think regulators are picking up speed again. And I think that the tug of war is, we're a little bit worried that something might go wrong, and we want to keep an eye on things, versus we've got all this pressure for growth, we need to take the brakes off, we need to deregulate and get everything going. And I think there's a little bit of tension between those two things. So the two big themes at the minute. First, there is a definite noise around financial stability. I think regulators, and this is very much a sort of global cooperation effort, certainly working within Invest Europe, for example, you hear the same themes coming back, and you say, well, you know, this has happened in the UK, and funnily enough, the same thing has happened in Portugal, and it's happened in Spain, and it's almost like the regulators are talking to each other. There is definitely that sense of coordination, and the themes there seem very much still focused on leverage, how much leverage there is in the system, and the messaging there seems to be not so much that we know there's a problem and we're worried about it, but we don't know if there's a problem and we're worried about not having the visibility. So a lot of emphasis on reporting, how do we find out, and a sense that I think regulators are still very much looking at this as a bank issue. You know, what is going to compromise the integrity of the banks? Are they overexposed? But then realising that maybe the banks can't provide that information to them, and maybe PE firms, for example, are better placed to say what they've borrowed than banks are to say what they've lent. So lots of ways in which the regulator is trying to get more data, better visibility. On a sort of similar financial stability theme, big focus on valuations. The FCA has just completed a very big private market assets review of valuations. The sort of impetus behind that seems to be a fear that maybe in the private space that valuations are maybe a bit stale because you don't have the sort of daily pricing you do in the public space, and then maybe investor allocations are being driven by, you know, very current data in one case, and perhaps slightly out of date data in another case. And so they're focusing very much on making sure private markets valuations are robust. Again, that noise is coming back from other jurisdictions, certainly within Europe as well. How is that working? The FCA's next project is going to be a review of conflicts to try and understand where there are conflicts and how those are going to be managed. So all of those, are the processes right? Are the structures sound? On the growth side, though, we are then getting but where do we take the brakes off? What can we change to get things going? And so both UK and Europe are doing big reviews of the A from D framework to try and work out what they can maybe take out that perhaps isn't needed. But it's interesting because the sort of noise, if you like, is very much this is going to be a big change, we're going to make things so much better. But then you look at the detail of what's being considered and you can feel the sort of pressure not to deregulate too much in case it all goes wrong, and actually the ambition gets scaled back as it goes through the consultation process. And I think that's interesting where a jurisdiction like Guernsey actually has the benefit of so much more flexibility and immediacy when you look at the whole process it takes to change a piece of EU legislation, even just a little bit. Less so in the UK, but even then, how to make a little change. I think Guernsey has a scope there to change things more quickly.
Thank you. Jerry, I'll go back to you if I may. How do you think the landscape has changed since Labour entered government last July? Has a shift in culture and of policy had a real effect on the fundraising market domestically?
I mean, it's less than 12 months, so it's difficult to say when you sort of measure fundraising in 5-year horizons, maybe even longer. It takes a career to raise a fund. So I think we'll not know whether Labour's policy or what Labour's attitude has altered that environment for maybe certainly for the life of this Parliament. I think policy can help with fundraising. It can make capital more available. It can also make the UK more attractive to receive investment. So certainly the trade deals that have been done recently with India, with the US, and yesterday with the EU are all going to help, because I'm sure that will make the UK economy more attractive for investment. The other thing that the government can do, or has done, is actually proactively push capital into the market. So we heard earlier from the Lord Mayor that the Mansion House Accord is going to make available 100 billion over the next 4.5 years for private investment, of which I think 50% has to be into the UK. So 50 billion over the next 5 years is going to help. The National Wealth Fund, 7 billion for the transformation of heavy industry towards more advanced manufacturing, greener technology, is also going to help that. The flip side to this has been the tax, unfortunately. CGT's gone up, business asset disposal rates have gone up, carried interest tax gone up. All of that is a negative or depression on what can be achieved and whether the UK is the right place to do that. The other one as well, which has put an incredible burden on our portfolio, is the NIC increase. So again, there's negatives and positives. I think it's fair to say that the government can only do so much. What's far more important in the fundraising market is the ability of the industry to deliver cash back into the structure, make genuine realizations, and then refunnel that back through the system. So I think that's probably a much more fundamental point around seeing deal flow come back, seeing realizations take place, and actually start to push the activity and move the cycle again. That said, surprisingly, for me at least, the UK was the best performing G7 economy the first quarter of this year. So maybe we are doing something right.
Thank you. Ed, Collar Capital focuses on investing into the secondary private capital market. Given the ongoing liquidity challenges, to what extent is the secondary market expanded for private equity an answer to these liquidity woes?
Well, I'd say Collar Capital's 100% focused on secondary market, and just sort of level set, there's sort of two areas of a secondaries transaction. There is the LP book, where an investor is investing in the 10-year fund, year 5, they're seeking liquidity. This isn't the open market, and so that's where a fund like Collar and other secondaries players would offer the price and step into the shoes of that investor. That is known as the LP book. And then there is the GP-led transaction, where for a number of reasons it might be an asset within that portfolio that is unable to IPO, or there is more value to be gained, so you look to a continuation vehicle. And that is where the secondaries fund would come in and say, will underwrite the whole transaction to continue the assets, and then existing investors can either stay in that fund and roll into the new fund or sell at a price to that secondaries buyer. Both areas are increasing in volume and complexity, and it's sort of here in the earlier panels with all the tech and the AI, it's getting there with our portfolio. So we are probably in 3,000 to 4,000 other funds, which if we say there's 5 companies in each, you've got minority positions in 20,000 companies. So it's producing liquidity to other investors. It is not necessarily solving the IPO other than the continuation fund. But certainly we have to look at the tech as well because of that volume. And that's the area that actually people are struggling with, is how to handle the volume. And ultimately, secondaries is increasing at pace. Someone said at a different conference, and I won't attribute it to Collar, is people look at the stock market and you buy your Apple share, Google share, and you don't consider that a secondaries transaction. The volume and pace of change in secondaries is when is the PE industry going to say secondaries is the norm, and the primary PE starts becoming more like the IPO market in the public markets. It's a changing world, and the pace and complexity is certainly increasing.
Thank you. Now, Ed, it would appear that Jerry is not a great fan of the Grand Duchy of Luxembourg, which plays into the criticism we hear from some voices that the EU can be overly burdensome and bureaucratic. When working with finance centres, how does Germany compare with places like the Grand Duchy of Luxembourg, and what elements are at the front of your decision-making in this area?
I'll just check Guernsey.
I'm thinking of, comparing, how does Guernsey compare? Sorry, Germany.
I was just checking you
That's
won't
a bit
throw
of a
me.
slip of the tongue. Taking you to a bit of awkward history. Apologies from Guernsey men and women. Let's not go there. Shall we rephrase that? Yes. How does Guernsey compare with the likes of Luxembourg?
I think you've got to look at the strengths that have been mentioned by others on the panel. You know, Guernsey has got high KYC standards. It's respected globally. It's got a risk framework. It's got the service providers, and it's got stability. And all of those factors lead into speed and execution and conviction of a transaction or fund actually happening. And I think Jerry was saying, like it's days. Certainly if you are moving at pace, you want to form that acquisition entity, set up the bank accounts, all the operational parts that come along with that new entity. That is happening in days in Guernsey. It isn't in other jurisdictions. And I'm sure we've all succumbed to Luxembourg wet signatures and all the other delays that actually seem minor but are critical on the path to get a transaction over the line. And Guernsey has all of these qualities, and the service providers certainly, and the people that are working in those firms, whether it is the law firms, whether it's administrators, the tax and accounting firms, the communication that happens is what enables those transactions to happen at pace, and that's a critical element. It's the same way with any transaction. If you have a buyer, they want conviction that the seller is able to execute on it, and the seller wants, obviously, conviction that they can actually execute on the transaction themselves. And that framework that exists in Guernsey is what enables it. Collar's been in Guernsey for 25 plus years. We've got 350, 400 entities in Guernsey. We like Guernsey. So, and it's for all those reasons. You have to operate at pace.
So, Stephanie, a paean of praise for Guernsey. But how does Guernsey create an environment that's going to continue to nurture innovation?
Yeah, and well, I think it's interesting because obviously there has been a challenge from Luxembourg in terms of where people are setting vehicles up. But when you talk to sort of some of our bigger clients who actually have things in all sorts of jurisdictions, it's interesting to see what is still in Guernsey, notwithstanding things they may have moved elsewhere. So, you know, we've got examples of people who still use a Guernsey fund admin for vehicles that aren't even Guernsey, because the quality of the service is good and people know it and understand it. And then you start to talk to people and it's like, well, yeah, but you know, our continuation fund vehicles are there, our co-invests are there, our deal aggregators are there. Anything that is a little bit quirky or different or doesn't fit nicely in a box, you know, if you want a classic flagship fund, you might now be looking at, you know, we need a Lux piece alongside our Guernsey piece or what have you. But anything that requires quick setup, flexibility, the ability to do things differently, people are still very much using Guernsey. And for me, that I think is something where there is a niche that is not going to be addressed by, you know, a big European piece of legislation or a big UK piece of legislation, because it's too sort of different each time from time to time. I think the flexibility Guernsey has means that there is a big space to play in there that for me is an obvious home.
Thank you. Aranpreet, let's go back to the spirit of the first question I asked you, and that's structures. Can you provide an insight into the opportunities to co-invest through Guernsey structures and some of the benefits?
Yeah, I mean, look, the dynamics on a co-investment are kind of completely different to on a fundraise, where perhaps you have a little bit more time and leeway to think about, you know, how long it will take you to set up your fund and getting your regulatory approvals. You know, co-investments generally tend to work on deal timelines, which are very much, you know, we need it to have been done yesterday. And I think one of the benefits of setting up, say, your co-invest vehicle in Guernsey, and to reiterate points already made, is, you know, we're talking about days here, not weeks, to kind of set up vehicles and get them regulated. You know, in the space of probably about 10 days, 2 weeks, you could have set up your GP, your LP, and have gone through a GFSC process, which I think is really critical when you're dealing with, you know, the deal guys who just want this vehicle set up so it can hold the deal. So I think that is something that you, again, to Steph's point about you can't legislate things like that away, and it's just a fact of the regulator being more nimble, the industry there and the ecosystem of lawyers and admins being more nimble in setting up these vehicles very quickly, which I think is really critical, particularly on co-investments. And anecdotally, you know, I've got clients that have their flagship funds being in Luxembourg, but have gone with Guernsey as the vehicle of choice for a co-investment. And I think another great thing about Guernsey is that it's a pretty flexible jurisdiction, you know, that there isn't an issue with that sitting alongside a Luxembourg fund. You know, a lot of the kind of mechanics can still work very well together. To Steph's point about where your service providers are based, a lot of our clients may have their Lux fund serviced out of Guernsey anyway. So it's you know, it could easily be the same team that is doing the admin function on both vehicles. So I think there are a lot of synergies there that are helpful in a deal context. And I think having a kind of well-developed and well-thought-through legal regime also helps. On a lot of these co-invest deals, your investor pool is naturally a lot narrower than you would get on your kind of flagship fund. You know, if you're doing a kind of single investor SMA, you're looking at one investor. And in a lot of jurisdictions, having that investor having a say over your investments and what the fund can do can cause you know, legal issues around whether their limited liability is lost. But, you know, Guernsey has a whitelist that you can point to and say, actually, if we're doing one of these structures and the investor's rights are just X, Y, and Z, then actually, look, this is no issue for you. And it's having had the background knowledge of having dealt with these structures over the past decades that has led to a very well-developed legal regime that I think, again, reduces issues that can come up further down the line with some jurisdictions where those laws haven't been tested as well.
Thank you. So I've got one last question, which I'll put to each of the panellists, beginning with Jerry. So a report published by the Frontier Economics last year found that £57 billion in foreign direct investment flows into the UK through Guernsey. If it had not flowed through Guernsey, but instead through the Grand Duchy of Luxembourg, I understand that 13 billion of that would not have been netted into the UK economy. In other words, it wouldn't have been coming here. So how important are international financial centres such as Guernsey in maintaining strong capital flows into the UK, and how can those flows be enhanced and strengthened, Jerry?
I mean, clearly the numbers speak for themselves. It's vitally important that kind of capital is channeled into the UK. It's coming from a number of disparate sources around the globe and actually being packaged in Guernsey structures and then moved on. How to ensure that continues, I guess, is to make certain that Guernsey has a high degree of reputable legislation, a recognised regulator, so that there are no issues around AML, KYC, that kind of stuff. And I think also probably a highly professional and educated workforce in the island that can actually process this kind of stuff and do it effectively and efficiently. So I think the accountants, the lawyers, the administrators are all vitally important in keeping that flow going.
Thank you. Ed, your thoughts on maintaining those strong capital flows into the account?
Just echoing the same sentiments, and I think it's, you know, if it's the school report, it's keep going as Guernsey is, and we look to the new opportunities, the innovation, looking at those investor passports, how can KYC and tax processes and onboarding be smoother. It continues to improve, it can always continue, but from our perspective, one of the most critical elements to attract money is the ease of entry into the fund. Having that as a smooth, efficient process rather than too many hurdles, too many delays, is equally a critical part of fundraising. So I think having that, yes, there are restrictions on why people have to go through Luxembourg when they're the EU investor, but the rest of the world likes Guernsey, and there's a lot of money to have an inflow of capital from those jurisdictions. Keeping the regulatory framework, the stability of everything that operates together with, mentioned before, the service providers, it makes it a good jurisdiction, an attractive jurisdiction for people to operate in.
Stephanie.
Yeah, and I think I would echo the point about stability, actually. I mean, when you look at sort of general disquiet when Cayman went onto the tax blacklist, for example, the uncertainty about whether that was going to be an available jurisdiction caused a lot of people to move away. And I think the work that Guernsey has done in terms of making sure it's on the right lists at the right time, and there's no questions around that, I think is hugely and will continue to be hugely important. And I think the ability to be nimble and move with the times, you know, there will be changes to AFMD in Europe, there will be changes to AFMD in the UK. Guernsey will, you know, adapt around that, and I think the ability to just kind of make sure that the choice is there. And it's back to Aaron's point really about, you know, you can choose this regime, you can choose that regime. If you want one of those, you can have one of those, but then if you're doing something different, we've got something that fits that box as well. And I think the ability to keep offering those options and having the multiple options is really useful.
Aranpreet, your thoughts on how you keep those capital flows into the UK?
Yeah, I'd almost go a step further and I say it's more about anticipating what client needs are going to be. I think the industry's evolving in a way and at a faster pace than perhaps it was a decade ago, and our clients are doing a myriad different things. You know, that there's more open-ended structures now. There's, you know, a lot of sponsors trying to access retail capital. You know, Ed was talking about the developments on the kind of continuation vehicle, GP-led side, and trying to make sure that Guernsey has the vehicles that give our clients the flexibility to cater for all of that, you know, whether it's just a more streamlined fund regime or, you know, protected cell companies or whatever it might be that allow them to fit their strategy within a neat legal structure, I think is kind of the way that you can stay ahead of the game. And it's a tricky one to do because you're trying to guess what the next big thing will be, but I think staying plugged in and keeping those discussions going with our clients is the way to make sure that you're always going to be a jurisdiction of choice, because you have everything available that a client might need for the next big thing that they're going to kind of devote energy and attention to within their business.
Thank you very much to our panel for that fascinating oversight, touching on Guernsey, the Grand Duchy of Luxembourg, not Germany, let's just clarify that. And thank you very much to our first panel.